Welcome to the InterMarket Analysis video update. This is a video that I like to do once a week, but I've taken a bit of a hiatus from that as I was doing some traveling. So now I'm back to doing this. The goal behind this video is to look at other markets beyond the S&P 500. That can include other areas of the stock market. It can also include the bond market, commodities, currencies, and things like that, just to see if we can get any clues as to the interaction of the different markets with each other. No market exists in a vacuum, and so we want to look at those other areas to see if they're having an impact on the S&P and can we gain any additional insight. This is being prepared for Monday, May 15th. The first thing that we look at is S&P 500 valuation. How is the market on a valuation basis? Is it considered expensive, inexpensive, or fairly valued? Well, I have a little cheat sheet up here where if we have a PE ratio of 20 and above, the market is considered to be expensive or overvalued. If we have a PE ratio of 15, which that makes a range between 11 and 19, stocks are considered to be fairly valued. If we have a ratio of 10 or below, stocks are considered to be inexpensive or cheap. Well, looking over here, we can see that we're above this red line. The red line is a PE of 20. The blue line is a PE of 15, and the green line is a PE of 10. We're above this red line, so that means that we're expensive or overvalued. Now, this chart looks at the trailing 12 months. It looks backwards based on earnings that have come out so that we know on a historical basis how is the market valued. This is another chart going back to 1980, just showing different major events in the market and what the valuations were at that time. Another thing that we look at is a thing called the Shiller PE ratio. This was developed by Robert Shiller and has gained a lot of popularity. Right now we have a reading of 28.91, where the mean and the median is between 16 and 17. So from a pure numbers basis, we are considered to be overvalued with this indicator as well. Now there's one issue that the market uses. It doesn't look backwards. It looks forward. So there's also a thing called forward PE ratios, and we look at those for the S&P, the mid caps, and the small caps. Those same PE ratio values of 20 or above, between 11 and 19 being fairly valued, and being 10 or below being inexpensive, those still apply to forward-looking PE ratios. The one thing to keep in mind is these forward-looking PE ratios can change because they're based on forecasts and guesses and optimism or pessimism, and so they can go up or down. As the S&P goes up or down, this value changes every day. The latest reading that I have on the 10th of May is that we have a forward-looking PE ratio of 18. So we're above 15, but we're still below 20 looking forward. When we look at the mid-caps, we have a current PE ratio of 13.2. That is below 15, so we're in between being inexpensive and fairly valued. And when we look at small caps, we're also between 10 and 15, giving us a current reading of 12.5. So small caps are considered inexpensive and a little bit under being fairly valued. Another area that we look at is growth versus value. So why do we look at that? Growth is when we want to buy low and sell high. Growth is when the indexes really go up. Growth is when you invest a little bit of money now, hoping to have a better return later on. Where value, this is the part of the market that folks get into that has more established companies. Maybe they pay dividends. Maybe they've been around a long time. Maybe they're quite boring. But when we're having difficult times in the market, value tends to outperform growth. Well, looking at this first chart, this is just a growth index where we're still in an overall downtrend. We came right up to the 200-day moving average and have been bouncing back down, even though growth is showing some improvement. Now, to make it even a little bit more confusing, value has also assumed a downtrend as well. We've had a recent death cross and value has been going down. So we want to be aware of that, but we look at a lot of ratios between growth and value, but please keep in mind that both are now in a downtrend. This chart just compares growth with value, where growth is still in an overall downtrend, but it's making a big improvement. If this keeps going, we might end up seeing a golden cross. On the bottom, we see an inverse of that same chart where value had been doing quite well. Now it's starting to underperform, and we could get to the point where we see a death cross. We also compare different indexes with each other, a growth index and a value index, showing that we're just seeing a golden cross here with the growth starting to outperform value. We also look at the inverse of that same chart, not quite showing a death cross yet, but value is starting to underperform where it had really been outperforming. We also look at a couple of ETFs. We're not quite at a golden cross here yet, but growth is showing some improvement. This is an inverse of that same chart where value had been doing a lot better. Now it's showing some weakness, but not enough yet to show a death cross. Then we also look at a couple of other indexes showing that growth is underperforming value, but it is showing a lot of improvement. And then we look at value against growth, which value is showing a lot of weakness currently, but not enough to generate any crosses. Some other areas that we look at are inflation gauges. On the top is a monthly chart of the CRB, which has been under a lot of pressure lately. At the bottom, we have a ratio between inflationary and deflationary commodities. When this is going down, that means we're more deflationary. When it's going up, we're more inflationary. So right now, we're below a declining moving average. So this would suggest that inflation is tapering off. Another area to look at inflation is the Baltic Dry Index. How much does it cost to ship products from point A to point B? This had been in an overall downtrend, even though it's starting to tick back up, and we might be seeing a golden cross fairly soon. The CRB, this is commodities, where we look at energy, agriculture, precious metals, and industrials. This is still tending to be in an overall downtrend. Some other markets. Here's the NYSE, and I show this every day in the daily video, where we're starting to drop below the moving average when we look at the NYSE advanced decline line that takes only common stocks into account. The S&P is still above the moving average, but it is declining. The mid caps are starting to show some weakness, and the small caps continue to show some weakness. We also look at the biggest software companies in the US, and they are still in an overall uptrend, even though they've seen some recent weakness. Then I look at a number of different commodities, not so much to base what they're doing, just to give you an idea where they're at. Where corn has been coming down after being at much higher prices. Aluminum is also coming down. Heating oil has been coming down. Gas has now been coming down. Natural gas, after hitting up around 10, is now dropped to 2.27. Oil has also been coming down. We also keep an eye on diesel. I don't have a regular chart of that, so I have to go out and find one. We really spiked up in 2022, but we have been coming down. In fact, we've dropped under $4. Wheat, after spiking up, has also been coming back down. We also keep an eye on fertilizer. This has also been in a decline. Lumber has also been in a recent decline. The dollar is still in an overall downtrend, but it's trying to turn back up and possibly put in some kind of a bounce. The euro is doing better than the dollar, and the Japanese yen is doing better than the dollar as well. The British pound is also in an uptrend compared to the dollar. The Japanese yen, even though it's going sideways, has still been performing better than the US dollar. Copper is really starting to show some weakness, and we call this Dr. Copper. When copper's going up, that tends to look forward at positive economic times. When it's going down, that's more pessimistic as to what will happen in the economy. It had been chopping sideways, but now we're starting to come down. However, it's still in an overall uptrend. The copper to gold ratio. Copper has really started to underperform gold. Here's a longer term look at that same chart, comparing it to the 2-year yield, where the spread between these two is pretty high. In a good, healthy environment, they'll tend to go in the same general direction, and even though they're on different scales, they typically don't get too far apart from each other, at least in the last 13 or 14 years. Gold continues to be in an overall uptrend, And then we look at gold on the top and silver on the bottom, and we look at the correlation between the two, where they have a really solid longer-term correlated relationship. Now this chart is a little bit in depth, where we're looking at the gold to silver ratio on top. And what research that I've done has found is that when the dollar index goes up, gold outperforms silver. When the dollar index goes down, silver outperforms gold. Now, both silver and gold are highly correlated, so they might be moving in the same direction. But when the dollar's going down, as it has been doing, silver has been outperforming gold. If we turn up with the US dollar index, then you might start to see gold outperforming silver. And then on the bottom, I have a correlation between the two, just showing how they tend to go in the overall same direction. Silver is also in an overall uptrend, even though it's seen some recent weakness. Looking at some indexes, the CRB is underperforming the S&P 500. The S&P 500 is starting to outperform the S&P. The NASDAQ 100 is now outperforming the S&P 500, and we've had a recent golden cross. Small caps continue to underperform large caps. Then some other areas, the equal weight index of the S&P 500 is underperforming the regular S&P 500, which is a weighted index, where in the S&P 500, all stocks are treated the same. Mega cap growth, this is where we're getting a lot of our upward movement from. We're in an overall uptrend, and we're actually trying to break out with this ETF. Mega cap growth is really outperforming the S&P equal weight index. We've had a recent golden cross with this ratio, and this is where a lot of the strength in the market has been coming from. The S&P 100, which are the 100 biggest stocks in the S&P 500, they are really outperforming the S&P 500, and we've had a recent golden cross. Low volatility stocks, which were a better place to be in 2022, they did see some weakness, but now they've started to shoot back up, and they're just barely in an uptrend. Then we compare the low volatility ETF with the S&P. It is in an overall downtrend and has been chopping sideways. The Dow Jones Composite Average, which looks at the Dow, the transports, and the utilities and combines them together, has been chopping more or less sideways, but is still in an overall uptrend. Then we look at the traditional Dow theory, where we were starting to come back up. We didn't quite get to this previous high with the Dow, but we're seeing more weakness in the transports. The utilities are looking a little bit better, but they are not really showing much of a breakout currently. Now we have a new take on Dow theory, which looks at the S&P 500 on top, and it's above what had been pretty significant resistance. We do have a previous high that may act as resistance. On the bottom, we compare that to the NASDAQ, where it is starting to break out above resistance. Can it maintain price above that level? The further this goes, the more healthy that would be for the market. FANG stocks continue to be in an uptrend, and I know they've changed the acronym, but I just stick with the old acronym. ARK continues to be in a downtrend. Then we look at the S&P 500 and then compare it to stocks in Europe, Australia, Asia, and the Far East. They are showing some weakness, and we're starting to go below this moving average. On the bottom, we have a longer-term PPO indicator, which continues to decline. Then looking at bonds versus stocks, bonds tend to be in an overall uptrend with the bond ETF. The World Bond Index also is in an overall uptrend. Stocks continue to outperform bonds on the monthly chart. And then bonds are really not breaking out when looking at a ratio to the S&P 500. High yield corporate bonds, you may also know these as junk bonds, continue to be in an overall uptrend. And investment grade corporate bonds are also in an uptrend. We look at the stock to bond correlation, they're having a real strong tendency to go in opposite directions. When we're below this blue line and above this red line, that's more neutral. When we break above the blue line, and the closer we get to 1, the closer they have a correlated relationship going in the same direction. When it falls down and the closer we get to -1, that means they're going in opposite directions of each other. The corporate bond index remains in an overall uptrend. Here's a look at the 10-year Treasury yield after really getting way above 4%, has now been coming back down. Here's another look at that yield, and we've been really choppy as of late. Here's another look at the bond yield where we're starting to see a death cross here with the 50 crossing below the 200-day moving average. Looking at the 30-year yield, it's also breaking out a little bit above the 61.8% retracement. We're currently at 3.78%. And the S&P, which had been underperforming the rise in interest rates, is now starting to outperform, and we've seen a recent golden cross with this ratio. Junk bonds continue to be in an overall uptrend. We compare junk bonds with government bonds, and junk bonds continue to outperform. We also look at bond prices, where they have been going higher as of late. The RSI is turning down, but still above 50. The MACD is crossing back below its moving average. It's trying to decide if it wants to be positive or negative. Here's a daily chart of the yields, where overall we have been coming down, even though on Friday we ticked back up. Here's a weekly chart looking internationally with yields in the US, UK, and Germany and how they've been acting lately. The US has been turning back up slightly, where the UK seems to be breaking out. We're seeing yields go down in Germany. We have Japan along the bottom. Their interest rate is low. They have another story that they're going through that I'm keeping a close eye on. Looking at the 5-year yield, which looked like it was starting to show some weakness after we dropped below this moving average. The special K is also turning back more negative, and the KST on the bottom is pretty much flat. So this could suggest that yields might start coming down. We also look at another weekly chart of the 5-year yield. It's still above this moving average. In the short term, we're trying to cross over back positive. We're just about on top of the moving average in the intermediate term, and we still continue to be negative in the long term. Looking at the 10-year bond, comparing the financial sector to government bonds, where the 10-year bond has dropped below the moving average. The ratio has also dropped below the moving average, and the long-term KST ratio is also declining. This would have a lot to do with the banking situation that has fed over into the financial sector. Long-term bonds continue to be in an overall downtrend. On a short-term basis, they had been positive, but now we're crossing over negative. In the intermediate term, we could be getting ready to go negative, but we're still positive in the long term. Comparing bond prices with the CRB ratio, where we have been coming down with bond prices and starting to go back up, we might have hit some resistance at this 12-period moving average. But if you compare the two on the bottom, bonds continue to outperform the CRB index. Then we also look at a ratio between bonds and the CRB index on a weekly chart. We're still below this moving average. In the short term, the KST is still negative, and it's kind of hard to see, but in the intermediate term, the KST is pretty much right on top of each other. On the top on this next chart is a thing called the MOVE Index. This measures volatility in bonds. We're not really seeing any extreme reading currently. We compare that with the VIX, which measures volatility in stocks, and there's a lot of complacency in the market overall. Then on the bottom, we show that there's a very strong correlation between these two indexes. Looking at the S&P and sectors, I talk about this every day in the daily video. In a good, solid environment, we want to see this ratio going up. Well, lately, it's been going down to sideways, so that's more negative. The staples sector, which got really close to a death cross, have seen a resurgence lately and are still in an uptrend. We look at energy against the S&P 500, where it really outperformed in 2021 and into 2022, but now we've seen a death cross with this ratio and an overall decline. The tech sector continues to be in an uptrend. Semiconductors, even though they're chopping sideways, they are still in an uptrend. The tech sector to the S&P shows that tech has really been outperforming the S&P 500. Then we look at the S&P 500 on top and we compare it with discretionary. Discretionary has been doing kind of well, but lately it's really been chopping sideways. We also look at energy to the S&P, where we saw a recent death cross and now we're seeing some weakness. Materials are also getting really close to a death cross on this ratio. The financials had a death cross already and continue to underperform the S&P. Real estate is also in an overall downtrend compared to the S&P. Utilities are also in an overall downtrend. Healthcare is also in an overall downtrend. Here's another look at healthcare showing recent weakness and a lot of sideways movement. Where communication, that has really been outperforming, and we've seen a recent golden cross. And looking at staples to the S&P 500, they are starting to break out a little bit again. Industrials are in an overall uptrend, even though they're showing some weakness. And the NASDAQ is now outperforming the S&P 500. The NASDAQ 100 is outperforming the NASDAQ. Then some other areas, we compare growth, which means growth stocks, with treasury bonds, which are government bonds, and growth has been outperforming bonds. We look at the energy sector and compare it with the tech sector, where energy is starting to show some weakness. We've seen a recent death cross with this ratio. The tech sector is finally starting to move up faster than interest rates. And here's an inverse of that same chart showing how the 10-year yield has been going down compared to the tech sector. Discretionary is still underperforming staples, but it's trying to show some improvement. And staples continue to outperform discretionary. Staples continue to outperform discretionary. Gold is outperforming the S&P 500, and gold is outperforming the US dollar. High leverage loans. These are risky loans, and if we were getting ready to fall off a cliff, would this be in an overall uptrend and actually starting to break out? Looking at our InterMarket Analysis chart, going back to the beginning of 2022, oil is still in the lead, where we have the dollar and gold pretty much on top of each other right now, and stocks and bonds continue to be negative overall. Looking at the regional banking ETF and comparing it to the financial sector, the regional banks are underperforming. Looking at our different yield curves, the 10 to the 2 remains inverted, and the 10 to the 3 month is also inverted. These are the two that we watch the most. The 30 to the 5 and the 10 to the 5 have now gone back to being not inverted. On the bottom, this tries to compare the 10-year yield with the Fed funds rate, but this information is only updated about once a month, so I don't use it very much. Looking at cash and comparing it to the tech sector, when this black line is going down, that means the tech sector is doing very well. Well, at the beginning of 2022, we started to break above this Ichimoku cloud, and that produced an awful lot of trouble. Getting into the early part of 2023 and up to the current day, we're starting to see this line go down, which is positive for the tech sector. Looking at some different indexes, the microcap index is still above 100, so it has not set a new 52-week low. The small caps have now turned negative. Here's the Russell, which has also turned negative. And small caps continue to underperform the S&P 500. The small caps for the Elder Impulse system remain negative. Mid caps, recent death cross and breaking below support. The Elder Impulse system for the mid caps is also negative. The Dow is still above its 50-period moving average. Can it bounce back up and take care of some of these pivot levels? The diamonds are negative. The NASDAQ is looking better. Looks like we could finally be breaking out above this potential quadruple top here, but we have upper resistance at this R1 level. Can it break through that, or is it going to come back down? The NASDAQ 100 looking a little better, but we hit resistance at this R1 level and then backed off of that on Friday. The Qs have now switched to neutral. And looking at our fib chart, we're still above this 38.2% retracement. If we keep going up, we might hit this 50% retracement level. The NYSE composite is still in an overall uptrend. The Wilshire is also in an uptrend. And then looking at our Amex, NASDAQ, and NYSE 5-period moving average of the highs minus the lows. And I point this out in the daily videos. We are below zero. To get more of a positive environment, we want to see this going above zero, and it's not doing that. All stocks, however, remain in an overall uptrend. Emerging market is also in an overall uptrend. Then internationally, we have China trying to turn back up. Emerging markets are trying to turn back up. Europe has already been able to turn back up. We're still headed lower with Japan, and we're still looking fairly negative with the S&P. Bitcoin, even though it's in an overall uptrend, has now crossed down below 30,000. Then some different correlations. We compared the S&P 500 to the dollar. they're having a slight tendency to go in the same direction. We compare the S&P to oil, where they're having also a pretty strong relationship of going in the same direction. Then looking at the S&P to the 10-year, they're also going in the same overall direction. And then the tech sector to the 10-year yield, they're also going in the same overall direction. Looking at the S&P to the 2-year, they have a pretty strong correlated relationship. Looking at the home builders, and I cover this every day in the daily video, where we've been going sideways with the S&P 500. We're going up a little bit more with the home builders ETF, even though we turned down, and the relationship between the two is starting to show some weakness. Some long-term secular and cyclical studies. This is a monthly chart of the NYSE. We're still above this moving average, but it is declining. The Copic curve is trying to roll back over positive, so that could be positive longer term. Here's another look at the NYSE composite with a thing called the NYSE record high percent index. We have been bouncing up. Then looking at the S&P with the PPO, this is also turning back positive on a monthly chart. Comparing the S&P 500 to the CRB index, the S&P 500 is outperforming the CRB. Looking at the S&P 500 and then a global index on a monthly chart, we're still above this moving average, but the KST continues to be negative. Looking at the price of the 30-year bond, where it had been under a lot of pressure, it came right back up to its 12-period moving average, but bond prices are outperforming the CRB. One of our positive things as of May 15th, and what I define as positive, is when the 50-period moving average is above the 200-period moving average. Dynamic software, the big 30 software companies, they are positive. The euro, the Japanese yen, and the British pound are all positive compared to the dollar. Copper is still positive, even though it's seen some weakness. Gold and silver are in uptrends. Mega caps are in uptrends. The low volatility ETF, which had gone negative, has now come back over positive. The Dow Jones Composite Average is positive. The FANG Index, all the different areas of bonds, the bond ETF, the high yield and investment grade bonds, world bonds, corporate bonds, and junk bonds. Staples are positive, tech and the semis, high leverage loans, the Dow, the NASDAQ and the NASDAQ 100, the NYSE composite, as well as the Wilshire, all stocks, emerging markets, and then not last or least is Bitcoin. Even though it's seen some weakness, it is still positive. What do we say about the negative side? These are when the 50-period moving average goes below the 200-day moving average. Growth has now switched over negative all by itself. It's still underperforming on a ratio basis, but the ETF that we looked at has turned negative. Value has also turned negative. The CRB index, the US dollar index, ARC, remains negative. And micro caps, small caps, and mid caps have all turned negative. So thank you. I hope you found this helpful. Please feel free to check out the supplemental video that I uploaded about a week ago. I also have a daily video and weekly video that I posted. After this, I will be looking to prepare what right now I'm calling the deep dive video, but I might be changing the name of that. So I hope you have a really good weekend, and I will talk to you in the next video.